This is an Uncovered Japan Company research report on Kissei Pharmaceutical, ticker 4547. Kissei is a Nagano-based specialty drug maker built around renal care, urology, and women's health. The immediate tension is simple. It has a remarkably strong balance sheet and a generous shareholder return profile, but its core drug business was loss-making in fiscal 2026. At the June 2026 reference price, Kissei traded on 11.2 times forward earnings and 0.70 times book value, while offering a 4.35% dividend yield. Net cash was 157.6 billion yen. These are compelling-looking numbers, but this is not a simple cheap stock story. The market is asking whether the operating business can consistently earn an acceptable return on that capital. For a first-time viewer, Kissei is not a broad pharmaceutical conglomerate. It concentrates on specialist therapeutic areas, then combines in-house development with co-promotion and overseas licensing. Its urology franchise includes Biova for overactive bladder, while its contract manufacturing arm puts existing production capacity to work for other drug companies. The result is a smaller, focused operating model rather than a scale contest with Japan's largest pharma groups. Revenue climbed from 65.4 billion in fiscal 2022 to 97.4 billion in fiscal 2026, roughly a 10.5% compound annual growth rate. But operating profit moved from losses to profit and back to a 2.9 billion loss in fiscal 2026. The revenue line shows a real growth business. The operating line shows why investors should not mistake growth for dependable earnings quality. Pharmaceutical products remain 80% of sales, so the core drug franchise still determines the long-run story. Within that mix, urology grew strongly in fiscal 2026, while the contract manufacturing business grew 63% from a smaller base. Those faster-growing lines are helpful, but they do not remove the need for the much larger pharma segment to return to sustainable profitability. The gap between operating profit and net income is central. In fiscal 2026, operating profit was negative, while net income remained 13.8 billion yen. The report attributes that resilience largely to gains from sales of cross-shareholdings, rather than the underlying drug business. That makes the balance sheet a source of safety, but it also means investors should track operating earnings and cash generation separately from reported net income. The balance sheet is undeniably strong. Kissei's equity ratio was 83.7% at fiscal 2026 year-end. But return on equity was only 6.3%, helping explain why the market values the shares at 0.70 times book. The opportunity is clear, if the company can use its capital more productively. The challenge is equally clear. A large asset base alone does not produce a re-rating. Kissei's advantages are practical rather than flashy. It has specialist relationships in selected therapeutic areas, partners that extend its sales reach, and an out-licensing model that can monetize assets abroad without building a full global sales organization. Its net cash also gives it time to invest. The limitation is scale. The moat is meaningful inside its niches, but narrower than the balance sheet might initially suggest. Kissei's Beyond 80 plan targets 110 billion yen of revenue by fiscal 2029 from 97.4 billion yen in fiscal 2026, alongside an ambition for return on equity above 8%. The path depends on product launches, portfolio cleanup, and better use of capital. It is a credible direction, but it also exposes the investment question. Can the company turn its pipeline and large asset base into returns that justify a higher valuation? Kissei sits at the low-price, low-return corner of this peer comparison. Its 11.2 times forward PE is below the selected mid-cap pharma group, but its 6.3% return on equity is also modest. This is why the discount should be treated as conditional rather than automatic upside. A higher multiple needs evidence that the core business and capital efficiency are improving. The report's 3-year scenario analysis is deliberately wide. The bear case is around 3,200 yen. The base case rises toward 4,680 yen by fiscal 2029, and the bull case reaches 6,300 yen. These are the author's estimates, not price targets. The useful takeaway is the dependency. Upside requires better operating returns and delivery on Beyond 80, while the balance sheet helps limit, but does not remove, the downside. Kissei is a well-capitalized niche pharma company with a high dividend yield, real specialist franchises, and an asset-backed balance sheet. The counterweight is a core business that was unprofitable in fiscal 2026. For investors following the story, the key indicators are simple: sustainable operating profitability in the drug business and visible progress in turning excess capital into higher returns. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or recommendation to buy or sell any security. Always do your own research.